Yeah. So, Kamath sir, if I remember the earlier various schemes like the CDR, etc., each of them had a time limit within which the asset should become viable. For example, if I recollect, infrastructure had 10 years, uh, normal account had a time limit of 5 years. But in this scheme, I have not. I've seen the circular, but I didn't find any such time limit within which the account should become a viable account. Is there any such thing prescribed, or what is your take on that, Mr. Kamath, sir?
Uh, Let me respond to your question like this. Again, this is covering two segments. One is the personal loans, and the second is the corporates. Of course, MSME is covered by a different scheme altogether. Uh, what it says is that both the personal loans as well as corporate loans should not carry an overdue beyond 30 days as on 1st of March 2020.
Hmm. Okay.
The second, guideline is that the advances should continue to be classified as standard till the invocation of the resolution framework. The whole scheme is applicable. Reference date is 1st of March. We are already in the month of September when the KV Kamath report came in. And this period of about 5 to 6 months, the account has to remain in standard category. Coming to personal loans per se, invocation shall be the date on which both the borrower and the lender have agreed to, resort to this scheme provisions and form a, resolution framework. The timeline for applying for the invocation of the resolution is latest by 31st of December 2020, and thereafter the resolution plan mutually agreed upon has to be implemented within 90 days, which means latest by 31st of March 2021. And the resolution plan is deemed to have been implemented only if three conditions are met, and they are: number one, all documentation work is to be completed in toto. Number two, the changes in the terms and conditions of borrowing must be incorporated in the books of the bank, which means should be entered in the core banking solution. And the third is the borrower should not be in default thereafter. This is with regard to personal loans. Coming to the corporate loans, there could be a situation where there is a sole banker, or there is a case of multiple lenders. In the case of multiple lenders, as Mr. Mohan mentioned, 70% by value, 75% by value, and 60% by number, should agree to invoke the scheme. In the case of sole banker, sole lender, he can go ahead with the provisions of the board approved policy. And as in the case of personal loans, here also the invocation has to be done latest by 31st of December 2020. Unlike 90 days in the case of personal loans, here the time limit for implementation is 180 days, which means latest by 30th June 2021, the whole thing has to be, implemented. And ICI intercreditor agreement has to be signed by all lenders within a maximum period of 30 days from the date of invocation. Those who have signed, if the 75% and 60% is satisfied, then a provisioning requirement, as Mohan mentioned, 10%. Those who don't subscribe to ICA, they have to, as a disincentive, provide for 20% for the restructured debt. If any of these timelines are breached, or if 75% and 60% don't approve, the resolution framework cannot be implemented. Like you mentioned in the CDR case, here also there is a standstill clause, which means that once it is invoked, no legal action can be taken. As Mohan mentioned, binding on all dissenting lenders also. The scheme, once it is approved by 75% and 60% criteria, the dissenting lenders can of course walk out by selling their share at mutually agreed price. In the case of MSME, as I mentioned earlier, the timeline for completing restructuring is 1st March 2021. With regard to viability criteria, yes, the general scheme says it has to be viable in the case of non-infra accounts by 7 years and infra by 10 years. And the concessional treatments cannot be extended beyond 10 years for non-infra and 15 years for infra. But here, the circular is not very explicit about those time frames, and whatever I have seen, some banks who have come out with the schemes, that the additional period for repayment that is given for additional finance that is granted is 5 years in some cases. So this is one gray area which sort of needs to be clarified. I'm sure going forward, it will be done. Now, this is my take on your question. Thank you, Prakash, and back to you.
Thank you, Mr. Kamath. So you touched one aspect which I want to discuss further is the case of multiple lenders. In case of corporate, I have seen most of the corporates do have more than one lenders, and many a times it's a syndication or a consortium arrangement. So I just wanted to raise this to Mr. Mohan. What will happen, like in case if minority lenders or some lenders who do not agree to the scheme, will they be forced to agree? Otherwise, they'll have to do additional provision. Can they simply opt out? What are the rules around this inter-creditor agreement? If you can throw some light on it, that will be quite great.
Sure. Sure, Prakash. Let me first admit, as a banker, in order to grow the balance sheet size, when the number of banks were very large in the industry, we had the players with 3%, 5% kind of share in the consortium. I have seen the consortium as big as 25 lenders for a large corporate. And to be very of the problems were because of this, and that is why 5 years back, when I was the chief executive IBA, we had moved the idea that no consortium should be more than 10 bankers and everybody should have a minimum share of 10%. And this is what precisely has been reflected in the circular which Reserve Bank has come out on the current account, that only those lenders who have got 10% plus exposure will have the benefit of direct operations, so that there is a proper control on the whole system. Now, the problem which you asked me, what is the treatment given to the said dissenting? Now, what happens that there is a lender with 20%, there is a lender with 3%. So the 20% has a different perspective, different concern, and he would like to be much more accommodative. 3% person, he feels anyway it's a small amount, let me have my cake or pie of the cake as much as possible, and so dissents happen. But right in the CDR and thereafter in all the schemes, there have been the disincentive that all the lenders are made as a subordinate. Those who have dissented are subordinate to the recovery which accrues to the lenders who have agreed for the ICA and restructuring. Because every recovery first goes to the additional lending which is happening, and the present lender does not get anything out of that, those who are dissented. But as rightly said by Mr. Kamath, that such lenders look for exiting through the ARC route or maybe some investor route. And it happens because there is a potential. But they would like to exit. Not that they don't believe in the strength of the viability, but they would like to exit. So this is the route they bear. And I strongly believe that going forward, the consortium should not be for more than 10 bankers, and minimum share should be 10% plus. Then only there will be a lot of unanimity and consensus in the approach to the restructuring. This is what is my suggestion. Good that you asked this question. We suffered a lot on account of this. I represented the big bank like Financial Bank and Central Bank and Union Bank, uh, and always had the problems of coming from the smaller banks.
Yeah, no, each of these banks will have their own, approach or an attitude. Or it
See,
could be because,
issue is that I, I, I as a banker look to it from my balance sheet perspective.
exactly.
That how it impacts my balance sheet in terms of
Mm.
capital, in terms of the quality, and so on and so forth. Somebody's phone is ringing. Yeah, he should be muted. Okay, so I think I have covered, and I express my heart as a banker.
Yeah. It's quite because a 3% lender, for him on his balance sheet, it could be quite so. And each of these banks have their own policies. Some are conservative, some are aggressive. So this kind of difference of opinion do happen. So
Yeah,
I think your suggestion is quite valid.
thank
So,
you, thank you.
thank you. So, moving on, see, COVID definitely has resulted in the huge liquidity challenges for many of the corporates. So, uh, this restructuring scheme talks about no restructuring of the loan, outstanding loan. But I'm sure because of this COVID, there could be a case in many corporates that there will be requirement of additional liquidity, and additional funds might be required for temporary purposes. So just wanted to ask this to Mr. Kamath, is somewhere this portion covered in the scheme that if a corporate wants additional funding, can that be given under this scheme?
Thanks, Prakash. I have already referred to this particular issue in my earlier comments.
Okay.
The resolution plan does include sanctioning of additional facilities, enhancing the existing limits wherever required, or even rolling over of temporary facilities given. Uh, Even if there is no renegotiation of the old debt, that means wherever there is no reliefs and concessions given, these things can be given in the form of additional facility. Lockdown has, as I mentioned earlier, resulted into huge liquidity stress, and they will be requiring a lot of startup expenses to be met, additional inventory to be acquired, etc., etc. Because on one hand there is no cash flows, on the other hand there is a need to restart the whole business, and therefore in most of the cases there will be dire need for additional funding, and the scheme does cover that. Whatever additional funding given under the resolution framework will continue to be treated as a standard account. Now, there will always be a time lag between the application made by the borrower for resolution and the actual approval of the resolution plan and its implementation. And in the intervening period also, the banks can grant additional facility, and that will continue to be treated as standard advances irrespective of its actual performance. Therefore there is a definite proviso to grant additional funding. Let this be very clearly understood by all the participants. Thank you.
Thank you. So I think we had few questions from the people on the asset classification, the provisioning requirement, the reversals. So I think we have covered all this in our discussion so far. So I'll move on to the next point about the KV Kamath committee report. Since it's the Kamath committee report, I will raise this question to Mr. Kamath again. Uh, so the 4th
Uh,
September, yeah,
no, go ahead, go ahead, go ahead.
yeah, yeah. So the 4th September recommendations that were out of Mr. Kamath committee, I think they have covered three main ratios on coverage, liquidity, and solvency. And also there is a 26 different sectors for which they have prescribed different service ratios. So I would like Mr. Kamath to just simplify some of these aspects of the Kamath committee report.
Okay. When the Reserve Bank of India, announced this scheme on 6th of August, they also simultaneously appointed the KV Kamath, committee to go into what should be the indicative financial parameters for various, sectors. And therefore, a few terms of references were given to this committee to look into and make recommendations. Therefore, one was to study the various impacted sectors of the economy and to assess the extent of stress. This was, reference point number one. Number two was to identify suitable financial parameters, to which you also referred to in your question, which should be factored into while drawing up the resolution plan. Number three was to recommend sector-specific ranges of such, financial parameters, because no two sectors are identical. Each one of them will be governed by different, parameters, different situations, different, circumstances. And the fourth was to make any other recommendations that the committee deems fit. These were the four, reference terms. The committee actually studied various sectors, which in fact covered about 72% of the credit portfolio of the banking industry, which is in fact a very decent, study coverage. The major findings of the committee are that COVID-19 has impacted even the best of the companies in the country. This is one, pandemic which has not discriminated between the rich and the poor, religion, caste, creed, nothing. Everybody in the country, be it small, be it big, are impacted. Uh, and their finding was many of these businesses were otherwise viable. Had the pandemic not hit the country, most of these businesses would be viable, notwithstanding a slowdown which was in the economy even before the,
Right.
the pandemic hit us in March. And the third is that the impact is all pervasive across several sectors, but in varying, severity. The degree of, adverse impact was different in different, segments. And the committee also acknowledged the fact that the banking fraternity will require, minimum reasonable time to study individual accounts and to come out and evolve a, resolution plan within the RBI, guidelines. Now, these were their major general, findings of the Kamath committee report. Now, major recommendations of Kamath committee report is that the banking industry should not, treat everybody alike. It is not one size fit all kind of a resolution plan to everybody. As I mentioned earlier, the degree of impact, severity of impact is different in different segments, and within the same segment, different companies will have, different degree of adverse, impact. Therefore, the whole accounts have to be bucketed into three categories, which is mild, moderate, and severely impacted, companies. This was their major recommendation. The mild and the moderate will have a very simplified restructuring process. The mild will have only principal amount reschedulement. Moderate will have both interest and principal reschedulement, reassessment of working capital limits, and unpaid interest getting converted into FITL, irregular portion of working capital getting converted into working capital term loan, but it doesn't envisage any additional sanction of limits or any deep restructuring. It is the severely impacted accounts which needs very complex restructuring, as we used to do in CDR or in the June 2019 circular of Reserve Bank of India. Therefore, various different kinds of treatment to differently affected segments.
Okay.
Simplified restructuring for mild and moderate, as I mentioned. Complex restructuring for the severely impacted. Coming to the financial parameters that you referred to, in fact, 5 parameters have been identified by the Kamath committee report. One is the total outside liability ratio to the adjusted tangible net worth. Total outside liabilities means all items on the very simple explanation, all items on the liability side of the balance sheet other than the capital and the reserves. Adjusted net worth means total net worth less intangible assets and investments in subsidiaries, etc. So this is one of the solvency ratios, as you rightly mentioned, which is also highlighted by Kamath committee report. The second is total debt to EBITDA. This is again the extent of leverage and the ability to service the debt. The third is current ratio, which is a liquidity ratio. It says in the short term is the company, short term is the borrower liquid. Can he meet the repayment commitments in the short term is what this ratio will indicate. The fourth and the fifth, the debt service coverage ratio and the average debt service coverage ratio is applicable in the case of term lending, which reflects the repayment capabilities of the borrower. So these are the 5 financial ratios or financial parameters which are identified by the Kamath committee report as a guidance, which must be factored in while evolving the resolution plans. And Kamath committee report, as you rightly said, has come out with these ratios for 26 sectors. For those sectors where Kamath committee report has not come out with these financial ratios, it is left to the individual banks to evolve their own acceptable ratios, accepting that in the case of current ratio, it should be minimum 1:1, and in the case of DSCR, it must be minimum 1.2 is what must be ensured by the bankers. These financial ratios are evolved and zeroed in by the committee after discussions with various bankers and various credit rating agencies. And while drawing up the resolution plan, the committee has very categorically mentioned that the pre-COVID performance of the borrower has to be kept in mind. The impact of COVID during the lockdown period has to be properly assessed, keeping in mind the performance in Q1 and Q2 to the extent possible. These performance needs to be kept in mind. The cash flows of the borrower needs to be assessed. Any success of the restructuring will depend on visible cash flows, and cash flows must be realistic. Let me also mention here that whole viability will depend on a few things. The pandemic has not come to an end in our country. We are not seeing the end of the pandemic is nowhere in sight. And therefore, the most severely hit segments, their viability will depend upon sector specific reliefs which the government of India might come out with, the steps that the government of India will take to boost the demand. It is easy to produce, but there should be demand. Then only sales can happen. So therefore, viability is contingent upon a few things. Therefore, those few things also need to be kept in mind and factored in while evolving the resolution plan. Like Reserve Bank of India's guidelines, Kamath Committee report also has accepted the fact that 100 crores and above, there has got to be an independent credit evaluation by one of the RBI approved rating agency, and borrowers whose limits exceed 1,500 crores, the committee itself, expert committee themselves, will validate the resolution plan. Broadly, these are the contours, prescribed by the Kamath committee report. Thanks, Prakash. Back to you.
Thank you. I think a lot of clarity has emerged from the Kamath committee. Okay. So I had few more points, I think, but in the interest of time, I will try to skip and touch the important aspects now. Uh, so the next important thing, Mr. Mohan, I want to ask you is, uh, there were a number of schemes in the past couple of decades that were announced by government, Reserve Bank of India, to help the genuinely stressed accounts. For example, we had CDR, we had JLF, CAP, Fiber 25, SDR, S4A, etc. But now most of the schemes were later on withdrawn, and we are not very sure about the success ratios of those schemes, though they were well intended. So just wanted to understand from you what could have gone wrong or what could not be achieved as per plan on those schemes.
Okay, so let me tell you, Prakash, primarily, let me admit, as a banker, each one of the scheme was well intended, and it's not well intended. It was addressing a particular kind of a problem
Okay.
which the industry was having. I mean, like CDR. Now, as I said, in the CDR, uh, it was the IDBI was the agency for driving it. It was all for projects, uh, very well driven for over the period. No issues on that. But since it was just a plain vanilla restructuring, and as we discuss about the various problems of the large number of players in the consortium, then came all the schemes during 2014 to 2018, all 5 by 25, S4A, and all those sustainable restructuring, or the whole issue in all these schemes, while they were well intended, they were addressed for a particular kind of a problem. In one scheme, the problem was 5 by 25 means if you had given the term loan for 15 years, you could have gone up to 25 years. So that was a wonderful kind of a support which was available. In another scheme, you could have converted the debt into securities. There are another very good intended circular. So all the schemes were very well intended. The whole problem lies in the implementation part. And in the implementation, as rightly observed by Mr. Kamath also, we do the restructuring on certain assumptions. And if those assumptions do not go right, and if they are not well monitored, there is a failure. At times, unfortunately, in the initial stages, I will not hesitate to admit that there has not been, or there has been a little misuse of this opportunity. For once it is referred to CDR, you get kind of a relief from all kind of action which could be taken. I mean, this kind of benefit, BIFR, all those benefit that you are free from all other kind of a. But with the enactment of the IBC, basically, all this was really not required, and that is how these schemes have been withdrawn. That you don't need a specific scheme. What you need is basically that do a time-bound restructuring, do a time-bound implementation, If you fail, go to IBC. See, there was a clear-cut guideline that if you fail to implement in 180 days, you have to go to the IBC and go for the. Again, I will say IBC is not for liquidation. IBC is for resolution.
Yeah.
So at times, what you could not resolve at your end will get resolved. So what happens that when you use it for the deferment of inevitable, that's most
Yeah.
important. See, any stress or problem account is like a cancer. If you identify the right time, there is a solution to it. But if you don't diagnose at the right time and allow it to be sustained, then you cannot hide. The amputation is the only answer. And that is what has happened, that somewhere what you call evergreening, what you call deferring the inevitable, when these things were observed because of the failures of the implementation, I think the schemes were withdrawn. It does not mean that those kind of measures cannot be implemented in the new. Basically, I will say that the present guidelines are very wide. You can cover anything and everything what is provided in the
Okay.
earlier schemes. That is what is my take. And I will only appeal that if it is done in the right perspective, we have seen that the restructuring done in 2008-9. Well, luckily that time the economy was doing pretty well, 8% GDP plus. If the economy shapes up, all these accounts should shape up better. As rightly said by Mr. Kamath, that the viability depends on various factors, not only credit. And thus the whole ecosystem has to really evolve to remove this uncertainty and look at the growth. That is what is from my side.
Thank you very much.